Ladies and gentlemen, I'm glad that you all are here with us today. I'm excited to look out in the room and see so many beautiful faces, and you all here ready to learn and explore more with us at the City of Little Rock as we seek to enhance and engage you all in financial literacy and build towards your financial future. I'm going to ask all of my panelists to just come on the stage because they can do a better job of speaking to themselves and introduce themselves than I can. So if my panelists will go ahead and join us, we want to talk more about this topic of family don't feud. Give them a round of applause as they come to the stage, please. We got Miss Shannon, Miss Kimberly. Let's go, let's go, let's go. Mr. Ivan, Mr. Daryl, Miss Ashley joining us too. We're making adjustments live on the fly. If you notice the song I came up to, If It Ain't About the Money, that's by T.I. and the now incarcerated Young Thug. But at the end of that song, there's a stanza by T.I., and it's one that really kind of stuck with me a little bit, if you will. He raps a little poetically, and he goes on a bit of a monologue, and he poses a question. If you pay attention to the album version of that song, he says, one question that I'll bring forward, should you choose to ignore it or choose to explore it, your children's future right now, would you die for it? So what we're going to talk about is our family, how we don't want to feud, and more importantly, making sure that our children have a future. So let me start right here with Miss Shannon, if I may. Shannon, I'll ask that you introduce yourself, tell us where you're currently employed and what you do. And let me ask you a question as a real estate agent. How would you recommend that someone interested in purchasing a home acquire or take their first steps toward buying a home?
Hello. I am Shannon Smith, principal broker and owner of SSD Realty Group. My first step would be, of course, to contact me. Give me a call. Let's talk about what your goals are, what get you on a path. A lot of times people just need a head start. They need direction. They need to know what the goal is. If your goal is, hey, going into 2024, I am no longer renting, that's where we start.
Thank you, Shannon. Now, we know before we get ready to buy a home, we're going to need this wonderful thing called credit, and that's where my man Daryl comes in. Tell us, Daryl, what credit is and why it's important in the home buying process.
So I'm Daryl Callum, owner of the Infinite Freedom Wealth Network. So I help individuals and business owners build credit to get approved for homes, vehicles, or funding to start or scale a business. But basically the basics of what credit is just the ability to get approved for goods or services without payment with faith that you'll make the payment in the future. So you just got to keep that in mind, whether that's through a lender, through an investor, or think about it, even if that's a friend or family member, you're trying to improve your credibility in the eyes of the lender.
That's wonderful. Now, we've all got those credit cards and know somebody who's acquired that credit card debt. We're going to come back to Daryl later because we want to find out how to rid ourselves of that. But before we move further, Ivan, I want to hear from you. Tell us a little bit about insurances, how we can protect ourselves, the different types of insurances. Please define different types, term, whole life. Tell us what that means.
Good afternoon. Thanks for having me. Thank you all for being here. Ivan Hudson, owner of the Ivan Hudson Agency. For the last decade, we work with individuals and families, even business owners, to help navigate, what it looks like to protect assets. We don't try to be all things to all people, but we are independent, which means our allegiance isn't to just one company. We work with multiple companies to do what's best for our clients. Also, we work around life events. So it's a big deal when we welcome a new addition to the family. It's a big deal when we have a big life event like we're purchasing a home, okay? It's a big deal when we're saying goodbye to a loved one or celebrating the life as well. All of those have various risks associated with them. And so as consumers, as kings and queens out here, we have to decide, do we want to retain that risk? Do we want to avoid that risk? And when insurance comes into play, is how do we transfer that risk from our household to the insurance company? So obviously, if you want to purchase a home, You get with Shannon Seals Deals, you get with your lender, but you cannot close. You're not cleared to close until you have that insurance binder. And so I'm fascinated by the concept of real estate because I get to work with professionals like these. I get to be a part of so many individual home ownership journeys. The whole concept of real estate, it may be your forever home. It might be a home that you determine that you want to generate revenue from. So now you need a landlord policy. There's a difference between a traditional landlord, which is defined by 12-month lease or higher, and the emerging concept of that's growing in popularity of short-term rentals. If you're doing the short-term rentals, then you need to make sure that your property insurance policy matches the risk associated with that. As it relates to life insurance, only thing that I would like to bring forth without trying to give you a lesson in life insurance is, yes, there's term insurance. Yes, there's whole life insurance. But the one that matters is the one that's in force when you pass away, okay? The other thing that I'll mention is...
Ivan, real quick,
Yes,
when you
sir.
say term and whole, define those terms for
Okay,
me before you
absolutely.
talk about that.
So, just like the name implies, if you have term insurance, that policy is good for a certain term. We might see 10-year terms, we might see 20-year terms, might see a 30-year term. Those are really good because if there is a mortgage or there's some outstanding debt that you would like to make sure is taken care of in the event of your untimely passing, then you can get a term policy that may or may not align with that term. I mentioned a 30-year term, might have a 30-year mortgage. That would be an example. A whole life policy or a permanent policy, like the name implies, it's in force for your whole life, as long as you pay the premiums, right? Those, by and large, cost a little bit much more than the term policy. So if you're, looking at your budget, then maybe the term might be a good approach for you. But there also are living benefits that are associated with life insurance. I believe the first panel talked about, your risk profile and taking advantage of investment opportunities. And so without going into too much detail, you can still have a life insurance policy that has a death benefit, but there are some products that you can take advantage of the living benefits that have a portion of your premiums that go to an interest-bearing instrument, and so your money can grow within your policy. I know there's a lot of, talk about, self-banking and things like that on IG. Just be real careful about that because, those concepts are some very complex, sophisticated concepts, and it's not for everybody. But if you get with a professional that can help navigate some of those things, life insurance can be an interest-bearing tool for you.
That's wonderful to hear. We talk about those living benefits, and it gives us the opportunity to do what we want to do here, which is to create that long-term generational wealth. Those living benefits allow us the opportunities to invest and possibly get those homes if we're just actually renting at this time. Before we go further, and I'm going to get to my star pupil that's sitting right here in the center. We know she's going to be the all-star. I want to talk to Ms. Kimberly, if I may. Ms. Kimberly, your time as a mortgage lender and a HUD-certified housing counselor provides you with a very unique perspective. We heard from your other panelists, but in your opinion, just in general, why is home ownership important? Why is it important for people to aspire to own homes?
So as the previous panel stated, home ownership is the #1 wealth building mechanism in America, period. When you look at a millionaire's profile, their portfolio, they're going to have some real estate in that portfolio. So because of that, you want to generate some type of home ownership. I think the biggest misconception is for first-time home buyers that they have to go out and buy this mega house. We all have to start somewhere. So start with that $100,000 house or 50, whatever it is, whatever your budget can afford, that's what you want to do. Homeownership is the #1 wealth building mechanism in America. Join the club.
Now let's put a pin right there because we're going to come back and visit that. But I want to talk to Miss Ashley, if I may, for a second. I don't know if all of you all remember this song, but let me quote one of my favorite artist groups of all time. It's the Temptations, right? They had a song that some of you might know, and it's called Papa Was a Rolling Stone, all right? Now, in the reframe or the hook of that song, they say, Papa died, and when Papa died, all he left us was what? Alone, not A-L-O-A-N, but A-L-O-N-E, all right? But when we die, we want to make sure we leave our children with something more than just a loan. And how do we do that? How can we make sure our children are protected when we acquire these assets? What is the best way? What is a trust? What is a living estate? Talk to us about that, if you will.
Good afternoon. I am Ashley Steps. I am the Dirt, Death, and Disability Attorney. I am pitch hitting for all of these wonderful people on the stage. After you go see them and talk to them, then you come see me and we talk about how to protect your assets or how to leave them at in the most efficient way so that you don't implode your family when you're gone. Okay. So we hear everyone nowadays on TikTok, social media saying everybody needs a will. So Arkansas is a very land-rich state. A will does not protect you in Arkansas. So has anybody heard of probate in here? Ooh, lots of people. Ooh, yay, my favorite. So probate is very expensive. I make a lot of money in probate. Call me. But my favorite thing to do is avoid it.
Real quick, define probate.
Probate is when you pass away and your stuff needs to get out of your name to your heirs, kids, or beneficiaries' names. It requires court. It requires a judge to say, yes, Ashley is dead, not coming back. These are her heirs. They get this, this, and this at this time. Okay? So who, what, when, where, and how. That's what probate does. In Arkansas, you cannot transfer land without a deed. So if, my favorite example, Big Mama died in 1965. I was not born. My grandmother's house is still in her name. She died in 1965. Arkansas says we can't transfer. Now, I own it, but it's in her name. So how do I fix that? Somebody before me should have gone to probate, but they didn't. I'm not going to point any fingers at anybody. But probate is how you get that from, if you didn't do any estate planning while you're living, the court will do it at probate. As I said, probate is expensive, it's time consuming, and it's public. So anybody can go look up that I own this property in Quapaw. They know how much it's worth. I get calls all the time. Do you want to sell it? No. So what I need you all to do is to start talking with your families about Big Mama's house, because I know everybody in the room has Big Mama or Aunt Jane or Uncle John's house that's still in their name, and the oldest child is paying the taxes, and everybody just kind of assumes that, oh, that's their house. Not always. Or we lose it in a tax sale. The tax sale that happens every May that the county puts on. So, but yes, estate planning, wills are not the best thing to have in Arkansas. It is a place to start. You can write your own will. You still have to follow the statute, so I can't quote it for you right now, but you can write it. But it's better to have a trust. There are two types. In Arkansas, you cannot write your own trust. So I know that somebody sends me this TikTok video every week that says, oh, call me and I'll send you this trust template. Don't do it. Don't do it. Only attorneys and judges can implement trust in Arkansas. So if you have one that you wrote or that you got off the internet, it's not valid, okay? So there are 4 Black estate planning attorneys in the state of Arkansas. We all talk to each other. We're all women. There's me, there's Shanine Sloan, there is Maya Gorey, and DeQuisha Prude-Wheeler, who's in Northwest Arkansas. So if you don't call me, call one of them. Okay.
So Ashley, I think you make a very good point. Number one, we need to make sure we learn about trust so that we can protect our assets when we pass on. Number two, we need to learn the difference between wills and trust. So I would encourage everybody to talk to Ms. Ashley before we move forward. But number three, we also learned, if you paid attention to what she said, that we cannot take financial advice from TikTok lawyers, right? I've been seeing something that's very popular on TikTok recently, and I've seen a guy, I won't call any names, but I've seen a gentleman talking about how you, as a nurse with a $60,000 income and 45% debt-to-income ratio, can go out and buy this $250,000 house when we have 8% interest rates. I wonder if that's actually true when your debt-to-income ratio is off. But I want to bring it back to you if I can, Daryl. When we talk about acquiring homes and looking at debts that prevent us from buying homes, what are some of the first debts that we should look at before we come see Shannon? What are those things we need to check off and knock off the list?
So maximizing your personal credit is real simple. Like, it just comes down to removing the negative items and building with positive items. You know, a lot of people, if you come from a family where you know how to have good financial principles, you know, you're going to pay your bills on time, you're going to keep your credit cards at a decent utilization, you're not going to have accounts go to collections. But let's say you don't pay your bills on time, and things get to the point of going to collections. A lot of people have items like evictions, repossession, medical bills, phone bills. Those need to be reprimanded before you go through the home buying process so you can maximize your credit and get the best rate in a sense. So it's multiple ways where you can go about taking care of those negative items, whether it's, work out a pay for deletion. Usually you can settle items for a lesser amount with the actual creditor, but also we have rights as consumers under the Fair Credit Reporting Act or what have you. It's different sections within that law, like the 609, 611, 613 section, that basically credit repair companies leverage on your behalf to help you legally get negative items removed from your credit. So once those negative items get removed, whether it's a charge-off, collection, whether it's a late payment, hard inquiry, once you got a clean profile, that'll help you maximize your credit score.
Now, you said something else, which were things that would be positive usage of your credit. So what is a positive usage of your credit, number one? And then number two, I want you to talk about credit cards specifically, and how should you maintain or use a balance on a credit card?
Absolutely. So I went over how to remove the negative items. As far as building with positive items, it's simply going to come down to having either authorized user trade lines or primary trade lines. So authorized user trade line is when, a friend or family member, they have a history on their credit cards or what have you. And they can add you as an authorized user, and now that age of credit history pops up on your credit report, which helps you maximize your score. And also, if they have their utilization at a decent rate, then that increases your utilization as well. As far as credit card utilization makes up 30% of your credit score. Payment history is 35% of your credit score. So simply paying your credit cards on time and keeping your utilization under 30%, that makes up 65% of your score. So under 30% is good, but in between 2 and 10% is excellent.
I just want y'all to know that Daryl is right now speaking my love language when he starts spitting out the data, the numbers, and the statistics. As the chief data officer of the city of Little Rock, that's something that I deal with every single day. And one of the numbers that I've learned and read about more recently that's a bit alarming to me is that when it comes to home ownerships, African American and brown families typically own their homes at about a 30% lower rate than white families. I want to ask Ms. Shannon and Ms. Kimberly, if I can, number one, why is it important that we close that gap? And then number two, Shannon, Kimberly, as individuals who have worked in real estate specifically, let's talk about when we do close that gap, how do we make sure that we attain the wealth that we need from the closure of that gap by getting proper appraisals and things from our homes?
I want to jump in real quick and piggyback off of your first question about the two major debts that prevent folks from being able to purchase a home.
Please.
Your car payments, you're living in your house. you're driving your house. Those car payments kill your debt to income ratio. And then we have to think about those student loans. Those student loans are major. I think it's unfortunate that so many people will get the student loans and borrow the max and get the refunds and do all of the stuff that everybody knows what people do in college, but nobody gives them the information that how that's going to affect them on the back end. So be mindful of that when you're getting your student loans. But those car payments, you know, when you come in and you have an $800 car payment, but you tell me you want a $600 house payment, that's a problem. That's a problem. So you want to be mindful of that. I just wanted to make that statement. Go ahead, Shannon.
Oh, yeah, absolutely. Yeah, no, that's not a problem. The first question I had specifically about homes is we know that African American and brown families typically own homes at about a 30% reduced rate than our white families. Numbers are about 44% or so, whereas it's 72% in traditionally white family. Why, first of all, is it important that we close that gap and improve home ownership in black and brown families? I'll leave that one first.
Okay. I am very big in education because these are things that our families just didn't know. If you think about your grandparents, you think about your aunt, your uncle, big mama and them, most of them, they already owned their homes. And so you didn't go through the process of purchasing a home. You didn't see it. It definitely wasn't talked about. You didn't even know if your parents were renters or buying. It just wasn't talked about. You know, we were all taught to stay in a child's place. So you just didn't hear about those things. And so now home ownership has become such a big thing. We're all having to learn this process. We're having to learn what our counterparts learned at the dinner table. And it makes me think about someone said one time, what they were talking about at the dinner table, a lot of us didn't get to sit at the dinner table. Mom or dad may have been working a part-time job. Dinner was either already prepared or, you know, you went in there and fixed you something else to eat. And so we didn't have those talks at the dinner table that they had. And so we are playing catch up. You know, when you think about this wealth gap, we are definitely playing catch up. But it's okay. It's doable. You have to make the first step. I also wanted to say, when you think about part two of your question, moving forward, let me give my own personal example is that me and my husband, he is a third generation. When you think about generational wealth, he is a third generation to live in his grandparents' home. So this was Big Daddy, Big Mama's house, and now we live there. He inherited it. So that goes back to the wills, the trust, the having those discussions of what the plan is, what's supposed to happen. And so when you purchase a property, you have that mindset. Moving forward, what can you do for your children, for your grandchildren? It's biblical. It's biblical for us to leave an inheritance to our children. And so think of that when you think about home ownership, how to take the first step, what are the things you need to do, and think about what goes after that. That first home, that can be your stepping stone. Like Kimberly said, it does not have to be the end all. You can have that first home and leave it as an investment property or leave it to your family and then go and get your dream home. But you have to start somewhere.
Let me jump back in there because you said something that I think is very key, and that's that the first home can become your investment home. If your first home becomes a tool and it's an investment home, that means that you've created this little thing called equity. Kimberly, anybody, jump in here. Can somebody give us a definition of what equity is, and then talk a little bit more about how we can use and leverage equity and experiences of what you've seen and things of that nature?
So back in my married days. I was married and got a divorce, and it's like, okay, so I have one daughter. We moved into a condo. We lived in the condo for a couple of years, and the owner asked me, did I want to purchase it? Now, my ex-husband and I had already owned our home. He asked me, did I want to purchase it? And I'm thinking, okay, and he did the math for me, and it was doable. I purchased that condo. My daughter started saying that she could hear me on the telephone at night, so I needed to move to something a little bigger because she didn't need to be in my conversations at night. So I kept that condo and purchased another home. So I had that equity in that condo. So that money that's in that condo is still there that I can borrow against it, but now I have some residual income. Now, I'm a single parent with this daughter trying to figure this thing out, thinking, what, can I do this? What if something goes bad in this place? I've got to repair everything. It all worked out. So I purchased the next home, stayed there, and then purchased another one, but I kept that home as well. So now I have the condo, I have the second home, I have my third home. So I am building not only my wealth, but I'm building equity in those houses, but I'm not touching the equity. I'm not touching any of that money that's just sitting there. I did refinance one of the properties when the interest rates were at 2%. And I'm just going to say this for all the lenders and real estate agents in the house. Y'all, 2% was unprecedented.
Amen.
That was
Amen.
not the norm. So when you go looking for houses today and they tell you it's 7 or 8%, that's pretty normal. That's average. That's pretty normal. And I know you get it all the time, Shannon. It's like, well, the interest rates are too high. If the interest rates are high and you can only afford, and I'm all over the place with this answer, and you can only afford that $100,000 at 8%, buy it. You can always refinance it. The rates may go down. Usually about 5 or 6% is what's kind of average. So the rates will go down, so you can always refinance it. So don't tell Shannon, I can't buy a house today because the interest rates are too high.
Well, let me tell you.
Go ahead.
People that want to buy, they are buying.
Very good.
I am still selling houses. People that want to buy will buy. Investors are still buying.
And how many times have you heard, I'm not going to buy because the rates
hundreds.
are not too... Exactly. But the properties are still available.
Come on.
The properties
come on.
are still available.
Let me make this even more complicated. So my friend Kim here has these 4 properties that her daughter is going to inherit. Now, if Kim was to just give her daughter, let's say 2 of those properties, we have a tax issue. Any tax people in the room? None? Oh, there's one back there. Okay. As a former tax professional, Kim is going to create an issue of capital gains for her child because she has built all this equity in this home. Equity is wonderful. It's amazing.
Real quick, what are capital gains?
Taxes that you pay on things that have increased in value since you purchased them. So Kim bought her condo for $1. Kim's condo is now worth $100. Kim owes capital gains on $99. Okay? Capital gains rates are fairly high compared to income tax rates, they're high. Let's say it that way. So Kim is going to pay 21.4%. I'm just going to assume that Kim makes average $80,000. She's going to pay 21.4% on that $99 because that's income to her, but it's not income that she made from working. Okay? But if Kim were to leave those 2 properties to her daughter via a trust or via some other estate planning vehicle, her daughter gets what's called a step up in basis. So Kim's daughter gets it for the $100 that it's worth now versus the $1 that she paid for it. So that eliminates capital gains for Kim's daughter if she transfers it using estate planning. So one of the vehicles that we lose our wealth is taxes. So that $99 that she paid 21.4% on could have been added equity in her daughter's home or her granddaughter's home.
So let me jump in right there, if I may. We've all heard this term, whether it be on TV, cartoons, watching a show or whatever, trust fund babies, right? Trust fund babies do just that. They've inherited wealth from trust, so they're able to use that wealth throughout life. I want to take a couple of questions, but before we get to questions, I want to ask Ivan one thing, that we talk about the potential of buying homes. A lot of people are afraid to buy homes because they don't want the responsibility that comes with home ownership. It's like, well, what if this happens or what if that happens? Ivan, I want you to talk specifically about home insurance and some of the things that home insurance helps protect the buyer from, so that we can wonder, so we don't have to worry about the what ifs.
Absolutely. That's a great question, actually. Most people get homeowners insurance because it's required in order to get that mortgage or purchase that home. And the mortgage a mortgage company is responsible or concerned about their interest, which is the direct physical damage to that property. They're not concerned about your contents. They're not concerned about the furniture in there. They're not concerned about your belongings. They're not concerned about that wedding band that you need to insure. They're not concerned about the liability. And so I spend a lot of time emphasizing, yes, there's a lot of responsibility that comes with home ownership, but there's a lot of exposure to liability, okay? And so obviously physical damage, you'll be protected against fire. You know, how many of us know someone that works for the fire department, a fireman? Okay, they have really noble profession, probably still get a pension, but guess what? They put out fires every day. And sometimes we don't realize that's the #1 property claim is fire. It's devastating too. Secondly, anybody remember what happened in Central Arkansas around March 29th, April 1st? Okay. All right. Heavy winds, tornado events, they are increasing in frequency and they're increasing in severity. Okay. There are a lot of folks that are still, you know, kind of sideways because they wanted to get the cheapest policy at the time, didn't read the policy. Let me just say, just like that home that you purchased is yours, that's yours, your insurance policy is yours as well. It doesn't belong to the insurance agent, doesn't belong to, you know, whoever introduced you to the agent. That's your policy. You have to take ownership in it. And yes, it might be 100 and something pages long. If you need some help going to sleep at night, just read your insurance policy, okay? But it's some good stuff in there because it will, one, either, you know, explicitly state what's covered, or it will explicitly state what's excluded. And so, you know, as the responsibility comes with that pride in home ownership, we have to, you know, get a little bit more acquainted with that policy that's going to protect that investment that we plan to leverage and pass down from generation to generation. From the standpoint of liability, we are in the most litigious society on the planet. Folks still, you know, the top two come-ups are I'm gonna hit the lottery or I'm gonna win a lawsuit. Even if it's a frivolous lawsuit, okay, you still have to spend money and time proving your innocence, okay? And so let's say your home has a swimming pool in the backyard. Well, does it have a fence? Well, you got a fence. Well, when you go out of town and you're advertising that you're, you know, overseas or somewhere, what happens when the kids down the street jump the fence and, you know, somebody gets hurt or injured on your property? God forbid that someone, you know, drowns in the swimming pool. These things happen every single day. And the judgments for these events are at all-time high as well. The claim settlements and the, you know, the payouts for these families. And folks might think, well, you know what, you know, my assets are in the bank and they're FDIC insured. Well, FDIC is for bank insolvency. It doesn't protect against, you know, judgments. And so we have to focus on the responsibility and the liability that comes along with owning a home.
So what I'm hearing, number one, is that insurance is a worthwhile investment, and number two, if you ain't got none, go talk to Ivan. Are there any questions from the audience? Or there we go.
Hey, good afternoon. Speaking of the FDIC insured money, it's my understanding it's only up to a certain amount that they insure. So how or can you insure additional funds past that FDIC amount?
So the amount is per institution, so per bank. So if you, what is the limit? We're going to say, I think it's 250 now. So if you have an account at Simmons for 250 plus a savings account for 75,000, that 75 is not covered at Simmons. So you need to move it to another institution. There's also insurance for credit unions that's similar but different. I think the limit is the same. So, but it's still per institution, not per account.
Ashley, this is for you. Beneficial deed, are you familiar with that? And how does that help the person who owns the home? If he or she should pass, it goes to that person's name that's on that deed.
Yes, so beneficiary deeds are a wonderful tool here in Arkansas. Not every state has them. I know a lot of, I'm also an elder law attorney, and those of you who are becoming seasoned, please do not put your kids' names on your property, on your bank accounts, anything. If they're anything like me and they owe Sally $200,000+, you are opening yourself up to Sally coming and getting your money versus mine. So with a beneficiary deed, that allows you to do some estate planning, leave your property to whoever you desire when you die. It avoids probate. It also gets that step up in basis that I talked about. Okay? So it is a wonderful tool. Deeds can only be prepared by attorneys in Arkansas. Arkansas, we have lots of land, we have lots of minerals, we have timber. We are also number 7 in the country for wealthy individuals that live here. So we have 140 millionaires that live in the state of Arkansas. We have 7 billionaires that live in the state of Arkansas. Most of those people got their money from real estate. So if there are any people in Southeast Arkansas or South Arkansas where Texaco, what's Texaco's name?
I'm sorry, actually I have another question for you. I have a niece, she was the only child that my brother had and he passed. He had nothing, no will, no nothing. Now, his property is less than $100,000. Does she still have to go to probate court in order to obtain his items?
So I am going to give you the answer we're taught in law school. It depends.
Depend on what?
As my insurance agent is sitting beside me.
So we need to have that conversation off the stage. Miss Ashley, let me ask you a question real quick before somebody else from the audience. Do wills expire?
Wills do not expire unless you have written another one that supersedes it. If you are writing your own will, you need to specifically revoke the prior will, so that is not an issue. But no, if you turn 18 and you write your will and you don't die until you're 90, that will you wrote at 18 is still valid.
Like Aretha Franklin?
Correct.
Okay, so when can we afford all of this? So I'm graduated from, I don't know, my bachelor's degree. Moving, trying to get a house, do things like that.
Can you hold your microphone up for us?
Okay, I don't like this thing. But when do we create these trusts? When do we own these trusts? With our first dollar, with our $50,000? Like, what should be our goal?
You know what? I'm gonna take that one. Y'all can jump in on this one. I think that's a good question, and I think that The only answer that I can recommend, and I would love for everybody else to jump in on that, is that you start where you are, you use what you got, and you let it take you to where you're going. You don't get it all at one time. It's impossible to do. I think the first step is having this conversation, right, and figuring out where you're at in the process, because everybody in the room that's looking at this stage and sitting in the audience is on a different level on their financial journey. Even all of us on this stage. All of us on this stage have different levels of expertise, and I would venture to guess that we've all learned something based on what another individual has said on this stage. So what we want to do is take the knowledge that we've acquired and continue to use it to grow. Your question, when do you get it all? There's no direct answer. I'm going to go back to what was just said. It depends. But we have to start somewhere and try something. So we start somewhere, try something, and allow it to take us one. Let's set a goal. I believe in setting goals and making things tangible. If you want to own a home, let's set a 5, 10, 15-year mark and try to get there. If we know that we need to drop debt, let's figure out how to drop the debt and go forth and try to get there, right? If we know that we have assets now, we want to protect those assets. So before we do anything else, we need to make sure that we do that. Does that make sense? Ask the questions of the right people, and these people on the stage, they're the right people. I would encourage everybody to engage with them. Engage with them and see how they can help you, because there's a lot of knowledge, there's a wealth of information, and these persons can help you get there. All right.
I'm going to counter that argument. The only person...
Hey, made me look bad.
No. His answer is actually very, very good, but there are some 18-year-olds in this room. You don't have a lot of liquid cash. The only person you really need to talk to on this stage is Ivan, because you're guaranteed to die. That's it. You're guaranteed to die. So you have burial. If you are 18 with a child, you have a child that still needs to be cared for. You can call me in your 30s. You can call me in your 50s. Call me before you're 65. But at 18 and you have an extra $30, I'm sure Ivan has a $7 policy that you needed.
Maybe 20.
I think you want
I might
to say
be
something,
aging
Daryl.
myself.
Yeah, so typically what I tell my clients, as far as building generational wealth and you're passing down assets to your family, obviously you want to get to the point of having a trust and, passing those assets down. The foundation of building wealth is cash flow. Credit isn't going to solve a cash flow issue. If you're not going to have a trust if your cash flow ain't right. You're not going to be able to invest in real estate if you don't have cash flow. So you have to figure out what's the value that you're bringing to the marketplace and how you can monetize that. So cash flow is the foundation. Second, I believe it's credit. Credit and cash flow is going to put you in position to make investments. And as Kim mentioned, real estate is the #1 way to build wealth in America. So whether it's real estate or business or what have you, you want to have good cash flow, get your credit right so you can invest in some real estate or your own business or other endeavors as well. And obviously you want to protect yourself and, then get to the point of having a trust where you can pass those assets down.
Hey, bro, I think we had 2 more questions.
How y'all doing? Xavier Chapman, recent graduate for Landon Smith College. Somebody up here mentioned that we should try to get our utilization between 2 and 10% for like perfection, but it's like social media gurus out there that are saying that you want to use whatever credit that you have to navigate in the world, so just buy everything off credit. So like, what would you all say to that idea?
So to maximize your personal credit, your utilization needs to be in between 2 and 10%. Definitely never over 30%. As far as maximizing credit to make investments, to make more money from the credit or what have you, you want to leverage business credit. So business credit is reversed than personal credit. The more you use, the more your business credit increases. So you can actually leverage that rather than maximizing your personal credit, which is the more you use, the lower your personal credit is going to go. If that makes sense.
And it depends on what your goals are.
Yeah.
If you use too much credit and you're trying to go purchase a home, then we have a debt-to-income ratio issue. And so you don't want that to happen. The most important thing that I can leave with you today is to make sure that you're doing a budget. That budget is vital to your life. You have to do a budget. How much money are you bringing in? How much money are you spending? Are you spending more than you're bringing in? A lot of times people are. I see it every day because the paychecks just keep rolling and they're just making it work. But if you look at it month to month within a 30-day window, you're living above your means. You really should be trying to live below your means. So to answer your question about the social media gurus is subjective, especially with social media, but it depends on what your goals are, and you don't want to overextend yourself, and that's where your budget will come into place.
April, was there one more?
Yes, my name is C. James Humphrey. I kind of got two in one. Ivan, I want you to kind of talk about how a whole life policy could gain value. And also, I don't know if this would be a question for you as far as with the estate planning, how, like, say if I have a trust and I want to have my beneficiary as my life insurance beneficiary maybe assigned as far as my assets, property, and everything to go to the trust. So when I do pass it down to my beneficiary, that is the trust of that. Like, who would that go into?
Yeah, so with a whole life policy, at the end of the day, it's still whole life. It's still life insurance. The government realizes that folks leverage life insurance as a asset building tool, and so they have certain allowances, certain amounts of money that can go up to a certain threshold. There are some components of whole life that maybe, let's just say, you have $100 a month is your premium. Well, maybe $80 of that will go towards the cost of administering that policy, but maybe another 20 of that will go to maybe like, let's think of it like a sub account that has some access to either an index or a other market, okay? And so that portion might be able to grow, some type of interest. If you really want to move the needle to leverage life insurance to, bank yourself or to be able to, might not be able to buy a house, but, maybe when the kid gets to purchasing their first vehicle, you might be able to pull some of that cash out. The premium you're not going to be able to do that with a $50 premium. You're not going to be able to, probably not even with a $100 premium. I mean, you have to, look at your budget, look at, what disposable income that you have, and it's no longer like you're paying a monthly bill for life insurance. It's a mindset shift to, this is my monthly contribution. So if you don't have at least a couple hundred, few $100s, this is me talking, in disposable income to contribute towards leveraging that whole life policy, then I wouldn't recommend it because it would take so many years for compound interest to take effect if you're only paying $50, $100 a month. So I hope that answers your question.
Kimberly, I'm gonna let you go real quick. I said Kimberly, I'm sorry, Ashley, real quick on that trust part because we got to get off stage.
Yes.
No.
Yes.
It's a quick answer. Listen, ladies and gentlemen, we greatly appreciate you all for giving us your time. If we can give the panel a round of applause, please. I would like to implore everybody, as April has already stated and reiterated, it would behoove you, if you will, to find out more about the City of Little Rock, boards and commissions, become involved. The City of Little Rock is not a monolith. We want to be representative of our communities, and we want to make sure that your voices are heard. However, when we go to certain meetings and when we do certain things to try to benefit the residents of the city, we hear one voice. And when you don't hear your voice, you feel like we're neglecting you, and we don't want to. We want you involved, we want to hear from you, and we want to know about what you think. We've got the downtown partnership going on. If you're not in there, get there. Let us know what you want downtown to look like so that we can make this city better for you. Thank y'all.